All right, well, joining us now for another perspective on the housing market is Bruce McNeilage, Kinloch Partners co-founder and CEO. Bruce, thank you for joining us this afternoon.
Thank you.
As we're seeing, though, even though the Fed, good to have you, even though the Fed raising rates, we're seeing the 10-year yield ticking up, mortgage rates, so for the 30-year fixed, ticking below 7%. Help us understand the correlations here.
Sure. So the 10-year Treasury doesn't necessarily affect the payments of commercial debt and what builders are paying, but certainly it's going to affect interest rates for the average person. And right now, actually, the rates as of yesterday were right around 7.25%, and that really hurts the entry-level home buyers significantly because they, barely can afford a house right now with the cost of housing going up because of supply chain and materials. And as that house goes up in price, it's knocking more and more buyers out of having the ability to purchase a home, and they either have to rent a home or stay in the home that they're currently in.
Bruce, just what's your assessment on the damage that the Fed has caused in the housing market? And I guess any concern that the Fed is doing too much with what it sounds like more rate hikes on the table?
Sure. So it's really going to be a trickle-down position where people are not going to be able to buy houses. It's going to hurt mortgage brokers. It's going to hurt bankers. It's going to hurt realtors, really hurt people. And I think what the situation was, people were not ready for this. It turned on a dime and really changed significantly more quicker than most people would have expected. So builders are still building houses, but they can't sell houses. And that's really putting builders in a position where they have to discount houses. And with the Fed raising things, as quick as they have done, it's hurting folks in the residential real estate business significantly. And it's going to take them many months, if not a year or two, to catch up because of what they've done at the Federal Reserve.
So then, Bruce, this supply and demand balance that the Fed is looking for, how far out do you see that being?
So what it's going to do is it's going to knock developers back, because if banks aren't loaning money to developers, or developers are skittish on developing land, that's going to put builders back several years, because you have to develop the land before you build the houses. And so during this time, builders can't get commercial loans, or interest rates are going up for those loans. Same thing with developers. They're having problems getting loans. And that's basically going to end up, again, a year, 2, 3 years in the future. It's going to have a ripple effect, because it's going to cost folks money, and it's also going to cost folks a lot of time, because they have to catch up because of the slowdown in the economy that the Fed is creating.
Bruce, we spoke to you about a month ago. You told us that traffic had been falling off just in terms of demand out there. We saw a little bit of relief, I guess, in mortgage rates this morning, although not too far below that 7% number there. Has demand declined even further over the last couple of weeks from your perspective?
I'm actually in one of my new houses we just bought from a builder right now, and demand has not waned. The demand is still there. The entry-level home buyer, the millennial, they want to own a house. The problem is the houses are without a reach. They might have been saving and looking at paying a 3 or 4% interest rate and budgeting for that. But now that the rates are up at 7%, it really forces those people that were working hard and saving for a house, it really knocks them out of the market, and it's making it tougher for all people to afford a house. And unfortunately, that has a ripple effect.
Mm-hmm. So then, in terms of inventory, obviously people holding on to the good mortgage rates they got before the Fed started raising interest rates. What is this doing for first-time home buyers? What sort of options do they actually have right now?
Well, if you can qualify for a mortgage, builders are discounting houses significantly. I've seen 10%, 15%, even 20% discounts to retail pricing for the entry-level home buyer to come in, take a look at houses, and able to close on houses. The problem is they just can't afford houses, and there are too many houses on the ground. So what builders really need right now is more buyers that can qualify for mortgages. The buyers are out there, the demand's out there, but just qualifying for a mortgage and then affording that higher payment is really a hurdle for the entry-level home buyer.
Bruce, you mentioned 10, 15, 20% discounts on the table right now. Could we see larger discounts if traffic doesn't pick up here?
Well, I think it could be a discount in the form of a number of things. They can give you different features in the house: free refrigerators, ceiling fans, credit for furniture, closing costs, credits, to get a mortgage and pay the points. And so I think, again, it's a supply and demand thing. We were in the Deep South. We were traveling through Atlanta, and one builder has 150 houses on the ground finished that they have no offers on. 150 houses, and that's one builder. Imagine a dozen builders. So really the builders are going to have to keep reducing their prices until the supply and demand takes care of their inventory, and then they can certainly level off those prices. But that's going to be a big hit to the bottom line of builders. But again, something's got to give. There's too many houses built and not enough buyers right now that can qualify for mortgages.
Yeah, and Bruce, I know that you're focused on the Southeast region right now. Is this more of a regional story, or is this scenario playing out across the country?
No, this is a national story. There are just not enough homes for people that want homes. The millennials are now in their 30s. They're looking to start homes in their subdivisions. They're moving out of the urban core and having children. So the demand is there. The problem is, give you an example, people save in 401ks right now. 401ks have become 301ks. So people certainly don't have the money, whether it's in savings, whether it's the stock market going down and retirement plans that they can borrow from. The money's just not there. The demand is there, and that's across the country. Now, the Southeast and the Southwest are certainly areas that have had much higher growth and much higher demand over the years, but it's a problem nationwide.
And Bruce, I want to ask you about some of the layoffs that we've seen with Open Door, with Zillow as well. What are your expectations here? We know that obviously that we're far from where we were at the peak of the pandemic when everyone was sort of clawing for houses right now. What are your expectations for layoffs in the retail industry here?
So those iBuyers will certainly be cutting back. If they don't have enough houses to buy and sell, that certainly is going to lead to layoffs and reduced income for the iBuyers. But this can be a trickle-down effect. You're talking about real estate agents, all sorts of different companies are going to be laying off people, banks, people that do mortgages, process mortgages, sell houses, realtors. They all are going to be squeezed by this. And I think you're going to see a shakeout across all the different industries that make up the financial positions that have to all line up for someone to afford a house. Banks are going to be lending less money, and there's going to be a lot of shakeout in the banking industry.
It's certainly a challenging time. All right, Bruce McNeilage, Kinloch Partners co-founder and CEO. Thanks so much.